basics with starting with DeFi, and we focused on a lot of things of where to get some of your info, find some things, and ensure you were using like the right links. Things like DeFi Llama is well known. If you want to check out a project and make sure you're not using a lookalike, you taking the link from DeFi Llama is often a better option. If you're wanting to do a swap with some token that's not like the most known token, and like Uniswap, where you want to go swap for it, like doesn't recognize it, and you have a few different things come up as the possible contract address, you can go to CoinGecko to check you've got the right contract address.
Right.
So it's like really, kind of very basic stuff. And that's not to say that, people should just know it. It's basic as in like, these are some of the things you need to know at the beginning of like how to make sure you're not, walking into obvious traps or things like that. And there are a few others, etc., that I'm sure I forgot. Today might not be as long. I kind of wanted to go. So next time I want to go into some of the different like game theory type games you can set up to try and support a token, make it interesting, the kind of like things that are going on at Curve in more detail, like the Curve or things like that. But to do that, I kind of wanted today to dive a little bit more into some of the details around like trading. Not saying that you should or shouldn't trade or anything like that, but rather things like the difference between like what is an order book, and we touched on a liquidity pool, but I want to take a little bit of a closer look at like liquidity pools and understand it as how it's different to an order book. And really, we need to know that to be able to speak about the main things I want to touch on today, which is impermanent loss and liquidity mining. Okay. So, first of all, let's take a look at a liquidity pool, because in some ways, actually, no, let's first look at an order book. We touched on a liquidity pool last time.
Right.
Okay. So this is just a very basic setup of kind of what some of the beginnings of an order book look like. So what is an order book? And again, stop me if you want to ask anything or add anything. Okay, so when you on a centralized exchange, like Coinbase or Binance or something like that, they're almost certainly using an order book. And like I believe that's what they're using at like the NASDAQ and such as well.
Yeah, I've had a little experience with this. It's essentially the highest ask and lowest bid, right?
Yeah.
So you're meeting in the middle somewhere between, sort of like an auction.
Right. Well, yeah, and sorry, go ahead.
No, I'd finished.
Oh, cool. Yeah, and so like when you look at something like this, like I've got here a price chart, and I'm looking at like 1 hour candles, like essentially what you have here is you think of this as a line chart, and you're saying, oh, this is price, this is the current price. Well, really, how is that derived? Well, any single candle, as we zoom in, and we see this last candle here, okay, we can see it has these wicks, at the top and the bottom. And I'm going to zoom in nice and close because I just remembered Andy was saying, you got these wicks at the top of the bottom and you got this body. And it's red in this case, and you might choose to color code it differently, but this really just means that, hey, I've got this chart set to a 1 hour candle, okay? So this candle will collect data for an hour, and where the price starts, if it goes below that, the candle is red, and if it goes above it, it's green. Okay, and so that's where so if it's red, the top of the body of the candle is what it started at. If it's green, the bottom of the body of the candle is what it started at. And then the wicks are the highest it's gone in that hour and the lowest it's gone in that hour. And then you can see this dotted line is where it currently is. And let's say this hour finishes off right now. Okay, then, well, this is ending as a red candle if it were to end right now. And therefore, really where that body ends is at the bottom. There is where the price was at the end of that candle. Okay, and then green would be the inverse of that. So you can see here, it started at this price, it ended at this price, but it fluctuated higher and lower than that in the middle. Okay. And you look at something like this previous hour, and you can see it's mostly within a very tiny body. So in this hour here, like the price dropped a little, but it went up, it went down, and it kind of came back to where it was before moving into this hour. Okay. And people will use all sorts of indicators, and some people will use different candle styles or things like that, or line charts. But people just generally tend to like look at it zoomed out, and if you haven't looked at these before, you just think, oh, that's price. But really, that's an accumulation. That individual candle is an accumulation of individual trades, and that's people accepting asks or bids. Okay, so there are people with orders laying out in a book somewhere that look something like this. Okay, and so we can say, oh, current price, like here it's 1,600. Cool. Okay, let's pretend we're looking at some other asset, and the current price is 210 pounds. I have this in pounds because that's what my Google Sheets defaulted to for some reason. Let's say it's dollars, but 210. Now that just means that's the last price that this asset traded at. Okay. But here we have people who have this asset, and let's actually give this asset a name. Let's call it Frog. Okay, Frog. Okay, Frog. Okay. Yeah, I should go with Frog.
There you go. We got to stay in character here.
So we have an asset called Frog. Okay, and it last traded at 210 pounds. Okay, and let me actually zoom in here as well because it's not going to let me. It's not liking it. There. Okay, so we have this asset called Frog, and let's imagine this is a coin, not an NFT, just to make it easier. And we have somebody saying, cool, I'm willing to pay. I have £100 that I'm willing to spend on Frog at a price of £200. So they want to buy half a Frog, a Frog coin. Okay, and they're putting £100 towards that. Or maybe this is two people, each putting up £50. But in the order book, there are £100 worth of bids at the price of £200. Okay. So that means somebody who has frog can come along and sell up to 100 right now, 100 pounds, or up to half a frog, and they'll get 100 pounds. Yeah, so because this bid is just sitting out there and it is ready for the taking. Okay, and then hell, there's a few more people who say like, I like it. I want some frog coin, but I'm only willing to pay $190 per 190 pounds per frog coin, and I have 150 pounds I'm willing to put down. So you can see there's like kind of, and this would be what people call support. So there's more support here, and then here there's people kind of waiting for a better deal as we get further from the current price. Okay. But here on the other side, we have people who are wanting to sell their frog. Okay. So when I was saying about, somebody wants to come in and sell frog, and there's people waiting to buy here. Okay. There's that's somebody who has frog and they go, I want to sell it right now. There's somebody else who has frogs that they want to sell. Okay, frog coin. And they're saying, I'm not going to sell right now. Okay. I want to wait for people who are willing to pay 220 pounds price for it. Mm-hmm. And then I'm going to sell 15 pounds worth. Or and in the other direction. So now these on both sides here are limit orders. Okay. That means they're kind of set and forget. That's people actually putting orders into the order book. Okay. And the fact that those are there are what allows some new person to come in who doesn't have the patience to say what they want and say, give me now. Okay. And they come in and they have and they do a spot buy. Okay. So, and they go, cool, I want to buy, for instance, 250 pounds worth. Sorry, I want to sell 250 pounds worth of frogs. Well, in this case.
Well, either way, I mean, at the current price, you could do a spot order either way, buy or sell. Your order book just shows where if your order changes, people are willing to buy more based on the price that they're interested at, be it a higher sell or a lower buy price.
Based on this price, so it's the reason I'm saying specifically they want to sell is because I've used 250 and that would wipe this out, but it won't wipe this out. Okay, so they're selling off the bat, then that's going to fill these. Boom. Mm-hmm. Gone from the order book. Current price moves here.
Right.
That's the last price traded at.
Exactly.
And now that doesn't mean somebody has to come in and fill in here. But, there's going to be some incentive to somebody's going to think, ooh, that's what the price is. And somebody might. However, because we can see the numbers on this side are bigger and the number on this side are smaller, you can kind of think of that as there might be more support here. Right. This can support quite a bit of selling before people coming in to sell kind of run out of money and they don't want to sell anymore. Right. But this is quite thin. So now somebody comes in, and let's say nobody has filled this up. Okay. And somebody wants to, let me change this from give me now to sell me now.
if they want to buy at a spot price, then they're going to have to pay $220 because that's the only thing on offer. Correct? Yep, that's right. Which is going to move the price back in that direction.
And they're going to say, sell me now. 60 worth. Well, that wipes. I mean, this all together is 65.
Right.
So actually, that wipes this out. It wipes this out, and leaves £5 here. So then the current price moves very quickly with just a £60 purchase. It moves it here. Direction. So we can say like that's very thin. Okay, right. So like this was set up so that, you know, it could moon quite well. Like hell, just somebody spent 60 and it's taken the price from £190 to £240.
Yeah.
You know, and of course this is a fanciful example, but like, so you can, in an order book, the depth matters a lot. And so you get this concept of order book depth. And a way of visualizing that you'll see in a lot of exchanges is like this. Okay. And I'm not sure if this is a GIF or a live feed. I found it just for showing this idea. But you can see this basic idea, and you know, it kind of gets deeper at certain points. You can see here in the green, it shoots up quite a bit. So there's, you know, quite a lot of people looking to buy around this price. So there's quite a bit of, you know, support here where it gets steeper, you know, rather than dropping. You know, almost like flattens out to the left. And so that's kind of a visual representation of what we saw here with this, you know, thickness. Okay, so it's not going to move as easily below those points unless, you know, a lot of sellers come in, which can happen. Okay. And so with an order book, you have all these individual orders that together make up this graphic, and collectively, you know, in a particular market on Coinbase or whatever, you can think of that as the liquidity of the market. Okay.
Yep.
So the more liquidity there is in the market, the harder it's going to be for a single person to come in and buy and sell and move the price much. And so your price
is going to be easier to. It's also going to be easier to get in and out of the asset fast if you need to, the more liquidity there is.
Exactly.
You're not having to wait for a sale or wait for a buy to go through. There's usually somebody sitting there ready to go.
Yeah, so your price is more stable. If you are a big whale or something and there's lots of liquidity, you're able to sell easier without, drop. If you're selling, and there's not much liquidity, you're going to drop the price fast. And I mean, I've spoken to a whale before who was hilariously telling the story of the time they dropped a certain asset by like a few percent on a major exchange. And on the one hand, like, it's kind of funny. At the same time,
depends on what side of the trade you're on.
They didn't, it's like it didn't make, I think, a big difference to them, but they didn't make as much as they could have. If either the market had been more liquid or they had, being a big player, like spoken to the exchange directly and did something like outside of the market, an over-the-counter trade or something that they, pre-arranged, something like that. Okay.
Right.
But so it's highly configurable. You can end up getting it, very thick in certain places and thin in certain places on an order book model. But because
one of the things that I'm sorry, I didn't mean to interrupt you. One of the things I've personally learned is a chart like that, or the book itself is a visual representation of the psychology of the particular market at the time. Whereas you notice the price gets lower. Well, if you've got a set current price, the further away you get on the low side, you get many more people willing to buy, and it shows you where the strong conviction is. Where on the opposite side of that, the higher you get away from the current price, it's showing you where people are like, this is going to be a sell wall. When it gets up to here, I don't think it's going to stretch any further. We're going to go ahead and start dumping more shares as it goes because the price is way up. So those little notches you showed in the graph that got thicker in spots just shows where some people are around the 11,196. It just shows where there's more people speculating that this might be a good spot to go ahead and take profits. So if you're trying to flip or make a fast trade, you might want to, come out of your position right before there, because you're going to have a lot of other people selling at the same time, which can
exactly
firstly flip it to the other side temporarily. And on short plays, you have to be fast and you have to know what's going on. Where if you're doing a long hold, you can sit back and watch that candlestick chart for days, weeks, months on end, and not stress it as much.
Right. I mean, so I, as you say, like here, it like shoots out to the left quite a lot. There's quite a lot of people waiting here to sell. So like on the one hand, maybe it'll shoot through and you can get a better price, or maybe you can join them there and get that price. But at the same time, if there's a lot of people waiting there to sell at that price, maybe it doesn't get there because a lot of people decide at the last second to jump the gun and sell here or something.
Front run it.
Yeah, exactly.
Front run it to make sure they get their order through before the price changes.
Exactly. And if enough people front run it, then it ends up creating
It changes the psychology.
So then the people sitting there don't get their price, and then the price comes back down and they're like, shit, I should have sold.
That's what a lot of people don't understand, is it is a living, breathing, moving chart. And as the price changes, all of those levels change on a constant basis. So anybody trying to make fast trades had better be ready to deal with more stress. They better have a more calm emotional state, as opposed to somebody trying to long a position for months or years at a time.
Well, so and all of this, like this data, is the cumulative orders of a whole bunch of people. Okay, but they're all held separately on the exchange in memory somewhere on a computer. And so order books really require fast, concurrent, live computation. Okay, so you really want it to be fast, and blockchains are getting better, but they're not good at that yet. And so actually some of the first attempts on Ethereum to create decentralized exchanges went the order book route, and they worked technically, but they didn't really take off, and they were less heavy, and I forget the name, but like so you can do it, but it's not necessarily the best idea. At least not right now, and wasn't in the past. And so that's why eventually the AMM, or the automated market maker, came out, which was DeFi's answer to that, i.e. the liquidity pool. Okay. And so liquidity pool makes this all smooth. Okay. You don't put in at a particular price. There are some things you can do with Uniswap version 3 to kind of concentrate it, but ultimately you end up with something that looks more like this. Okay. And so this is the basic X times Y equals K. Okay.
Okay.
And that is how you find the price. So this quantity of B tokens in the pool, quantity of A tokens in the pool, okay? And then you just, like any chart, imagine some numbers here on the left, some numbers here on the right, and that shows the exchange rate between those two tokens, okay? And whatever the ratio of those two tokens is, if you imagine it here and we take a line there and we take a line there, then what we have is how many tokens of token, what quantity of token B will give me what quantity of token A, okay? And that's the current price. Now, so when people come to a liquidity pool, you're just able to add tokens of A and B to the pool in the ratio that it's currently priced at, okay? And with your most basic liquidity pools, you have to add equal value of both, okay, to keep it in balance. So if you're adding...
So essentially what you're saying is liquidity pools sort of move more like futures markets on different currencies against each other, as opposed to having a currency set in, say, US dollar. You're trading the lira for the drachma, for instance, and putting the other one out, and that's just the exchange rate difference in the two?
Well, not really, because I mean, even when you're like any market, you are just dealing in a ratio of two assets.
Okay, I got you.
So I mean, if stock market, you're thinking about the stock in dollars,
right?
Whatever. But it's really just that. It's a dollar and stock. I mean, and when you look at currency, it's I see the mental connection you're making, but
yeah. Whereas in the stock market, then it's based on the U.S. dollar. The U.S. dollar is a stable coin, so you're only having to calculate one side of it, which is the price of the asset. Whereas in trading one crypto against another, where both assets can change price to different, sizes and speeds and rates and all that stuff. And what they're trying to do is find a common medium as, hey, I want to trade A for B. And this is the set price for A right now. This is the set price of B for right now. So this is the ratio you're going to get in your trade.
Right. I mean, in this example of A and B, B could be USDC. It could be a stable coin.
Right.
And so, and yeah, you can, if you're looking at the stock market, just, think in dollar terms, but like when you get more sophisticated, traders and institutions, they will also think about, it's going up in dollars, but actually also the dollar is busy weakening right now against the euro. So is the stock actually going up in value, or is the dollar just weakening? And so maybe maybe actually it's not the stock going up, and so I shouldn't be buying some, but instead I should actually just be getting out of the dollar into something else. And what is actually strengthening is the Singaporean dollar or something like that. And so that's when you get into like three assets, you kind of or more, and you start looking at relatively at these things.
Wow.
But in a particular market like this, where we just got a rating two assets of token A and token B. And so in the liquidity pool, we've got this, position, or we got this price, and you spend tokens A, and you gain tokens B, and it shifts the price along this curve. So there's now a new ratio between the two assets, because you come and said, okay, I'm not providing liquidity to the pool. I'm going to put in some tokens A and take out some tokens B based on the current ratio between these. But by doing that, you've changed the ratio. You've shifted price. Okay. And so that's what's happening when you're doing a swap in the liquidity pool. Okay. So last time we touched on how you might choose to provide liquidity to, sorry, before I go into that. So, and then the more of tokens A and B there are. So say I have 100 tokens A I'm spending and I'm getting out whatever, 20 tokens B. Okay. The higher the quantity of tokens B and A currently exist in this pool, the smaller my spend of 100 of tokens A is going to change the ratio that already exists in this pool. And so the smaller distance I'm actually going to move on this curve. So instead of moving here, if it's a bigger pool, I'm going to move here or here. So it becomes harder. And that's, that equivalent of when we're speaking about, where the order book is thin in some places or thicker in some places, the more liquidity is in this pool, the less price moves from a specific size trade.
I got you.
So
I understand.
So if you want, and you say, hey, I like token A, I like token B. I don't want to trade between them. I have some of both, and I want to help provide liquidity to this pool so other people have a good trading experience. And for that, when they trade tokens A for token B at the ratio, they actually leave a little bit of token A on the table as the trading fee that goes to all the people providing liquidity in this pool. Okay. And, so that's one of the reasons people will, provide liquidity and they go, I'm going to go put some liquidity in this pool and earn some yield. And we touched on that.
So instead of going into the casino and gambling and playing the hand of blackjack, you're going into the casino and investing in the casino to make a profit overall.
Yeah, exactly. I mean, however, there are risks.
Okay.
So the one risk that, is kind of most bandied about is called impermanent loss. Okay.
Right.
So when you come and you put tokens in to this liquidity pool, tokens A and tokens B, you no longer owe, you put in, let's say it was 100 of token and 20 of token B, because token B is worth 5 times more at the moment.
Right.
Okay. So that's the ratio of them. That's the current price. However, you no longer own 100 of tokens A and 20 of token B. You now own a percentage or a size of the liquidity pool.
Yes.
And as the price changes, like maybe you actually now own 90 of token A and 25 of token B. I don't know if those numbers check out exactly, but as the price shifts, what you have is a claim on a piece of the liquidity pool in whatever is the current ratio between these two assets. Now, as that ratio shifts from what it was originally when you went in, you're actually losing value. And what you're trying to do is you're hoping that you are going to make more in fees from people trading in that pool from what they're leaving on the table than you're losing in value in terms of drift from the original price. So we can look at things like an impermanent loss, and that's called impermanent loss. Okay. So you can use an impermanent loss calculator to see, how much impact that has. So let's say we were actually in a USDC to ETH pool. Okay. And we entered the pool at, USDC is $1 for 1 USDC. That's token A. And token B, ETH, at the moment is somewhere near, I mean, let's actually check what it is. Okay, let's say 1,600. Okay, it's 1,590, but actually, let's use 1,590. We can get specific here. We got a nice tool. And let's say we, based on whatever, some analysis, astrology charts, our gut, tips from a friend, whatever it may be, we think that, and we've chosen that token A here is a stable coin, so its price, assuming the token should stay stable. So we're just, in this case, thinking about, token B, which is ETH. And we think token B could go up to, well, let's say down to $1,300. Okay. Right. Well, that means we're going to lose 1% of our original value. So, yeah, if we put in $500 of token A and $500 of token B, if we'd held it, we'd have, hold on, how's it not coming to $1,000? I haven't used this in a while. Value of held. Okay, yeah. But we can see basically that we're going to have a slight difference here between these two values. So we put it in at this price. The price now moves there. If we take it out, we're going to have a few dollars less. Okay. Right. If we had just held at these prices, and then when it moved here, we had sold dollars, we would have instead of this. Okay, so that's actually why it's dropped. Because our token B value, if we're just holding A and B, and then the price of B drops, well, we've lost value either way. But if it's in the liquidity pool, we've lost slightly more. Okay?
Right. That's a lot more.
Yeah, 0.5% more. I mean, if we go to $1,000, that's 2.5%. It starts looking, like, hey, we had $1,000. If we just held it, we would have had now 814. But in the liquidity pool, we have 793. Okay, so the reason it's called impermanent loss is because you don't really realize. Sorry, yes.
Because it sounds better. Because it sounds better than bag holder.
That too. But only when we take it out of the liquidity pool do we realize this ratio. Okay. Right. So if we stay in the liquidity pool and then it comes back to 1,600 and boom, we're doing well. Okay. So like what was looking like a loss starts being all right. Okay. So why would you ever provide liquidity instead of just holding? Well, what this doesn't account for is how much are you making in trading fees. So if you have these two things and you think the trading fees are going to, you think the ratio between A and B is going to hold, then if it holds perfectly, which it won't ever quite, then anything you earn from trading fees is additional money. But so if you like Ethereum and you like Bitcoin and you think that the value between them isn't going to change much for the foreseeable future, you might go, okay, cool, I'm going to provide liquidity and earn trading fees on them. So I get more Ethereum and more Bitcoin.
Right.
Or you say, I don't really mind which one I get more of, because even if it shifts a bit in the long run, I think they're both going up, for instance. Okay. Still, this impermanent loss is, it's pretty hard by just trading fees to beat, the risk of impermanent loss. So it doesn't look very attractive by itself. Okay.
But if you were in a bull market, it would, because everything's running. You're going to expect the price to go up, and you can earn the extra yield from the fees. So it would be an attractive opportunity in a situation like that. You'd still be taking risk because anything could happen at any time, and drop the price. But if everything was on a steady climb, like in a steady bull market, nothing parabolic, but just a steady natural climb, then a liquidity pool would make sense, because along with your asset value increase, and you're also drawing a little bit of interest off of having it in the pool itself.
Well, okay, so let's play that out quickly. Let's pretend now token A isn't a USDC. Okay, it's just token A. We have token A and token B. Token A is $150. Token B is $1,600.
Mm-hmm.
And let's say in the future they've both doubled. Okay, this is your bull market scenario, for instance.
Right.
So 300, not 28, 2x, and this 3,200.
Right.
0% impermanent loss, even though the price of them both has doubled. The ratio between them has stayed the same. So your relative price of these two assets, like we're speaking about, there's this third asset over here called dollars, and they've gone up in terms of that, but A to B is still the same.
Right.
Okay. And so then you have 0% impermanent loss, and you have 0% impermanent loss, and you earn some trading fees. In that case, you're winning. However, this would still be a bull case if I did this. This has gone from 150 to 200. This has gone from 1,600 to 3,200.
Right.
And we've made 2% less than if we just held A and B, didn't put them into the liquidity pool, waited for the price to rise, and then sold them for dollars.
Gotcha.
So here we've gone up to 1,666, but if we just if we just held, but because we provided liquidity, we actually have like $34 less.
But that doesn't account for the trade fees that you're accumulating.
Yeah, it does. It doesn't account for the trading fees, but the period of time to make 2% on trading fees, unless like you get certain platforms that might have ways that they're trying to boost the trades you have, or you have a very high traded market. So there are some things that could help balance that out. Some platforms have tried to do things like impermanent loss protection. I'm not sure that I've seen a good way to do that. But this is still the case. Both assets have gone up. You're in the profit, but you're in less profit than you would have been if you just held and sell at the same time instead of putting in liquidity pool and taking it out. For instance,
what's the point in adding to a liquidity pool in the first place then?
A few things. One, if you have a long-term view and you are confident about the ratios, because say you have a lot of both assets,
right,
and you want to be in that liquidity pool for 5 years. Okay. Which is longer than DeFi has been a thing. Okay. Right. Then those trading fees can stack up. Right. Okay. And assets you're comfortable with and a protocol you're comfortable with, That's the one reason. The other reason is liquidity mining. Okay. And liquidity mining is say, okay, there is a token C. Okay, so token A, token B, and let's introduce a token C. And we have a project that is, for instance, a DEX, and they say, we want people to be able to trade. We want them to come trade with us. And so to incentivize you to provide liquidity, we want people to trade between token A and token B. We want that to be possible, and we want it to be nice and deep so that people have a good trading experience. It doesn't shift the price too much. So we are launching our governance token called Token C. And when you put liquidity into our liquidity pool, we're going to give you rewards in Token C, for instance. Okay. And that's really where then people try and make up the difference, where they say, oh, I might be exposed to a permanent loss of 2% or more, maybe, especially when you have things that are really mooning hard or crashing hard, like these numbers can get massive. Let's say this goes up to 8,000. Oopsie, my 8 key didn't work. 18% less than you could have made. Okay. So, but people are trying to make up for that risk by they're getting free tokens of token C. And then, token C has some value or the illusion of some value based on what it's useful for and, the current state of the market. So let's take a look at Curve, not in full detail, because we're going to do that in a future thing. And we can see that. Okay, so we have here 3 pool, DAI, USDC, and USDT. So this is a very convenient pool of 3 different stable coins. And so they're saying like, hey, this pool here, you can trade this stable coin for that stable coin, whatever. So it can be, it's good for the market because it helps treat these different stable coins as equally, so people can use it to, like, if there's a pool they want to go to and it's USDC for ETH, but they don't have any USDC and they want to buy some ETH, they only have DAI. Well, they could trade the DAI here for USDC and then trade the USDC for ETH, or there'll be some tools that help kind of automatically do that, etc. So it can kind of help round trip certain trades to make it feel like it's a single trade, but actually there's more under the hood. Okay. And you can see we could come here and add DAI, USDC, and USDT, and there's very little risk there of impermanent loss unless one of the stable coins fails. Let me just quickly see who joined us.
Ribbit.
Oh, yeah. What up, Lobo?
Oh, no.
And so, here we don't really have as much risk of impermanent loss unless something really goes very, very wrong. And we have the trading fees of 0.39%. But we have these additional rewards in Curve, their native token. Okay? They have CRV, which is Curve token. And if you provide liquidity to this, then you can actually you can take that liquidity pool token that you get back, which is like your receipt. You can stick it in the bank with them, stick it in a contract, and you'll get extra rewards. So 0.93%. So actually in total here, you're getting like 1.3-ish. Yeah?
Okay.
Oh, sorry. I thought you were saying something. And you can see that actually shows 0.93% to 2.33. And that's kind of, and you can see here when I hover, max APY can be reached with max boost of 2.5. And so we'll dig into some of that next time. But that's really some of the games I was speaking about, where like, oh, they're trying to incentivize you to provide liquidity, and then they have some other incentives to try and get you to keep your liquidity there long term, because it makes them a good market for people to come trade. And so they're giving you extra rewards in their token, and they're trying to do this in such a way where their token doesn't just have bullshit illusion value. Okay. If it does, you might, like, because it's very easy for me to create a token, give rewards for providing liquidity, and give big rewards, and that token maybe has a high price. But the bigger the rewards and the higher the price, the more incentive it's going to be for the person who was there early to take the rewards and sell them at some point and run off. So it can crash the price.
Right.
So they have a bunch of mechanisms to try and avoid that, as well as they have sane returns. So when you're doing that, and that's liquidity mining.
I want insane returns.
Right.
They come with insane risks, sir, but they do exist.
True. Very true. Lots of stress, lose hair very fast.
Now, so, and you can see there are some pools that are more attractive, like this one, DAI, USDC, USDT, and LUSD. 6%. That's pretty good. I haven't looked into this pool. I don't know if it's because the pool is smaller or if it's because people associate risk with LUSD, whatever it might be. Okay. But yeah, so the point being, your returns have these two components. There's the trading fees, and then there's these additional boosts. And that's they're doing to try and attract you to Curve. And so then you really have to think about, and you saw the number just changed. And you have to think about, do these rewards cumulatively offset my risk from impermanent loss? And of these rewards that aren't trading fees, where do they come from? They all come from this Curve token. Okay, why does this Curve token have value? How do I maximize that? Do I expect it to continue to have value? And therefore, does it offset my risk long term? As you can see, this liquidity pool is 3-way. We were looking at 2-way earlier. And so we were looking at, in here, we were looking at these have a 50-50 ratio, but you can kind of get more creative with it. You can look at something like Balancer, okay, which has pools. I believe they have up to 8-way pools. And you can also set different ratios. They don't all have to be the same. So you could have like a 3-way pool, which is 20% one coin, 20% another coin, and 60% the third coin in value, for instance. So you can set up these different balances. And, so we have one here that's 3-way. I'm not actually sure what SFRX is, but I know RETH is Rocket Pool ETH, and WSTETH is wrapped STETH, STETH being an ETH equivalent from Lido. So these are all, so I assume SFRX is another ETH liquid staking protocol. And so we have here probably like 3 different equivalent forms of ETH. And in fact, let's look, this is volume, pool value, APR. Okay, let's come back down. So the pool's not huge, but it's not tiny, $6 million. The volume's not huge, but that's some pretty nice sounding returns. And let's see what it's made up of. So you can see actually here, there's multiple different returns. Okay, so here the APR is because, well, RETH, STETH, and SFRX ETH each have their own native returns. They have an interest rate associated with them already, naturally. Plus, then you have the swap fees. Plus, you can lock up your liquidity pool tokens to earn some BAL rewards for balancer. So you get these scenarios where you get cross-protocol like incentive programs, or you get multiple interest-bearing tokens, and you can kind of put them together in these larger pools. You get people layering this stuff. So you end up with people earning, whatever, 5 different tokens in rewards, etc. And so it's really important to understand, where each of your returns is coming from, what token is associated to, and the risks associated or rewards associated with that token. So if you're in a pool where you're getting 50% APR or APY, but it's all in some shitcoin that's going to drop to 0 tomorrow, you might think you're earning a lot of interest and offsetting your impermanent loss risk. But, if all your returns are in some shitcoin that you didn't sell in time, you might not have been offsetting that risk. Or you might have a combination of really good coins that you like, and it's actually a balanced thing. And you're going, hey, I'm earning 5 different tokens. I've got a decent return that I like. It's split between these different tokens. They kind of hedge each other. I like this. Yeah. And I believe that's what I'm trying to remember if there's anything else I wanted to touch on today, but that's really what I kind of wanted to look at, is the differences between order books and liquidity pools, some of the unique risks with liquidity pools, and then, how we get into why use a liquidity pool if you have all these risks. And that really gets into then liquidity mining, which is trying to offset those risks. But, sometimes it's just the illusion of offsetting the risk. There was something I wanted to show last time, which I didn't. And so I'm trying to now the name. Is it Dex Tools? Yeah. So I was showing Uniswap last time, and I wanted to show another platform where people, who want to be degen, might come and look at things. Okay, and you can see here, there's a bunch of different, I'll be able to find it just now. There's a bunch of different chains you can look at. Oh, here we go. There's a whole bunch of different chains. And we're looking at Ethereum. But when people are trawling for stuff, and you can see hot pairs. Okay, I have no idea what this token is. X2Y2 is trending. Okay, that's interesting. I know what that is. OME, I have no idea what that is. Let's look at what it is. It's probably a terrible idea. If it's number 1 on hot pairs, it probably means somebody's about to get rugged. Okay. Okay, and here we have some candles. We have a price chart. This is coming from a liquidity pool, but you can still kind of, construct the same type of candles, even though it's not an order book. And this is where it kind of starts being useful. You don't have to trade through this platform, but if you want to, there's some things we can see here which are useful. Where is it? Okay, there's a link to the contract, link to the website, link to the CoinGecko, add the token to your MetaMask. It's got a lot of convenient things here, but it doesn't actually guarantee you safety about the token. They can't really do that. And they give here a trust score. Okay. Now, the trust score comes from a bunch of things. Okay, so we can see, sorry, I'm going to zoom in more because I just realized my screen, Lolly made the point before.
Thank you.
So this, so we can see here underneath this price chart, all of these trades that have happened, people buying, selling this token and the amounts that they've done it for, etc. But really useful. Okay, so they give scores on different things. So they're looking at how many transactions are there and like how many different wallets are involved in those transactions. Because the more people are trading their token and the more wallets, the better chance it's trustworthy.
Got more liquidity.
Yeah, exactly. It's got some liquidity. It's less likely to be fake. And they're giving it a good score on transactions. Okay, holders. How many people hold the token? They're giving it a good score. Creation, 91 points. So they lost some points there. I'm not sure exactly how they're rating this. It might just be that it's a relatively recent token. I feel like I've heard the name OMI, so it might be around for a while. It might have been around for a while, but okay, token description, 1 goal, $100 million. This Inu is like none before. Okay, so this is a shit coin meme coin. Okay. Yeah. So the creation, they've lost some points for some reason. And the pool has 99. But like, let's see if we can find a terrible one. Okay.
That shouldn't be hard.
Because what this is useful for the DEX score is they'll sometimes point out things. Okay. People aren't being DJ. Why is it not? Toshi. I guess the ones that people are currently looking at in terms of the popular ones are not. Sorry?
So that chart was sort of popping. You do have some long upper wicks on that last one, but other than that, it looked like a steady climb.
I didn't see. Okay, but like this one, they don't trust the liquidity pool as much. Maybe the pool's a bit shallow. Maybe the liquidity's not locked because a project, you can lock your liquidity in a liquidity pool for a period of time. And if you're a project creator and you hold a large amount of the liquidity of the token, that can be a good way to give people some security, is actually lock your tokens in there. So you say, hey, I can't rug out all the liquidity when the price is favorable to me. I've locked it. And if you actually have, you can be checked on chain. And so they might be taking things like that into account on the pool. Also information, I'm not sure, maybe they don't have a website, that they do seem to have one linked. Community trust, only 50%. There's only 8 votes though. But this will also pick up on things. Like here, actually, mint. Looks like the owner can mint new tokens. The owner may have renounced, and it says unrelated to this token. You can see it's not highlighted, but it's not relevant here. But, token lock, proxy. Okay, so proxies are useful for having upgradable contracts. But for some things, you don't want a contract to be upgradable because that can be how somebody can make a change after the fact and screw you over. For game stuff, you probably want upgradability. For a basic token contract, you don't really want to, even if that token is used in a game. Okay. So there might be good reasons why a token people can mint more and it's part of the contract, but it might also not be a good reason. So something like Dex tools, and there are other ones out there as well, will cotton you on to some of that. It'll point some of that out, and it's not perfect. If just because it has a high score and highlighted doesn't mean it's safe. But
one of the things I was going to say is a lot of times, especially if you're experienced with technical analysis, some of these charts can look really good, but a site like this, all you got to do is scroll down to that token description. You realize this is just a fad and a shit coin that's not going to do anything any other than any other shit coin. And yes, that chart might look good, but when people start picking up on what the hell's really going on, it's going to dump. So that might be something that you'd look at for a possible short or a fade, where you see that there's no substance behind the project really, other than, hey, we're a store of value, we're going to the fucking moon. And they're actually climbing and climbing and climbing. So you look for them to break that upward chain. When they do, you just start looking for some break beyond support. You can snag them all day long.
Right.
So you can look at both. You can look at both sides of it. I mean, the chart may be looking really good, and people are wanting to FOMO into it. But when you go down and you realize that it's just bullshit, that what that's actually doing is setting a smart trader up for an easy fade.
Well, yes and no. So not all of these markets can be easily shorted.
Okay.
Even though you have a trading chart here,
right.
These are essentially spot markets. And
I got it.
To short, you need to be able to borrow the asset. Essentially. And if it's a new shitcoin, there's probably not going to be many markets that allow for people to lend that out. Okay,
yeah,
so
that is true. That's true. That's just the first thing I think when I think technical analysis. I don't even go into what it is until I look at the chart, and then I start trying to make a decision there as to what to do, because a lot of times people get FOMO and they'll want to jump in there. But you need to sit back and do your own research and realize check to see if it's got any substance. And there's always that time where you might not think that it's gonna pan out, and you decide not to FOMO in, and the damn thing, it hits a moonshot. It happens. The odds of that are very, very low. And by paying attention to your technical analysis, you can realize where you're jumping in that order book. You may think, well, I'm getting a good price. Well, this shit's already pumped 600%. So where you think you may be getting a good price, you may be toward the end of the pump and jumping in on the wrong
piling in too late, chasing green
exactly. You're jumping in deep water and you ain't going to be able to swim. So you might want to do your research, and it's not necessarily that it's a bad project. It's just you may be getting in at the wrong time.
Yeah, like whoever it was who bought here.
If you jump into a FOMO, and like if this was the best project ever out there, but you jump in at that top wick, I mean, you might have to bag hold that entire fade and wait another year or two before it goes up and actually does what it's planning on doing. And it doesn't make it a bad a project or a protocol or anything. Just that you chose to jump in at the wrong point in time in its value cycle.
Totally, 100%. Like, I have no idea. Kike is what this token is called. Right. As I said that, I realized that sounds like I'm not a horrible person. That's not what I meant.
It's probably not going to do very well.
KAIK is this token. Kaiken Inu. Okay.
Yeah, that is not going mainstream.
God damn it. Anyway, so and say somebody here then bought this right here because they thought it was going to continue pumping. Yeah, as you're saying, they're now down 73%. Unleveraged. They've lost 73%.
And a year from now, it may be 1,000 times higher than that. But that's the point of people doing their own research and at least checking out the technical analysis, because if you jump in at the wrong point, you could be getting in the best project in the world, but you're going to absolutely hate it while you're bag holding the thing, unless you want to sell for a loss, which takes an impermanent loss to a permanent loss.
100%. And I mean, as you said, but like you also made the good point of like sometimes there are ways to benefit off a market, even when you see it's doing badly. That can tell you interesting things. Even if it's not a market you can short, there can be ways you can turn that into an opportunity. It might tell you something about the current state of the market. And also, when you're looking at things like this, like even if a chart you think it looks interesting, like you got to remember to look at things like the liquidity. It's not just a pattern of lines. You got to remember to look at the scores about the contract. Like, can they mint? Is there liquidity? How many holders are there? Like, is it trusted? Let me take a look at their website. Okay, I'm gonna look at this website now and probably get hacked. Oh wow, this website makes my eyes bleed. I don't want to touch it. I mean, I love dogs. They chose the least cute dog.
Right. That's the one from that commercial, man.
Now I don't really want token.
Because they smear him in mud and put on some Sarah McLachlan music to try and get you to donate.
So those are all true and useful things. All right. So I think that's the end of this session. If you want to end it, Lolly, but I just remembered that this is a useful platform I wanted to touch on last time, which I didn't, because these are useful indicators. They don't tell you something's safe, but they can be a good indicator that something's.
The more information you can get, the better.
Now, are these all in Georgia?
What?
That went over everybody's head. Indicator. Come on, guys.
Oh yeah. Okay.
I'm missing something. Apparently, I'm just not American enough to understand.
It's a city. It's a city in Georgia.
Decatur's in Georgia.
Yeah. It was a Lobo joke. It's okay.
Right.
We're all good. We're all good.
Lobo, you are a dad, so you're allowed to make dad jokes.
There you go.
Exactly.
All right. Are we